Good afternoon, everyone. I appreciate people coming in and not leaving, so thank you for doing that. Ignacio invited me to give this topic talk today, and he leaves because he's setting up for karaoke and warming up his voice. So I'm sure everyone's excited to hear what songs he's going to sing today. But my name is John Kim, and today I want to provide you with a bit of an update on the environmental liability and property marketplace, and some of the trends that we're seeing, with the underwriters and the insurance companies. So what are the hot topics right now? I'm sure many of you are aware of PFAS. I'm sure that's embedded in everyone's minds, and so it's also embedded in the minds of the underwriters as well. So, what I want to talk to you about today is, a few things: PFAS and redevelopment. Those are the two top focus points that I want to talk to you about today, because those are probably two of the most concerning issues right now for environmental underwriters. PFAS, I don't know if anyone attended the PFAS session, which was held at 3 o'clock today, but provided a lot of really good information, from a case study perspective and also from a regulatory and litigation perspective. But what are we seeing? We're seeing increased trends in not just claims from toxic tort claims from third parties for bodily injury, but we're also seeing a lot of increased litigation, right? Increased regulatory scrutiny, not just in California, but in other states as well. And Michigan in particular is, one of the states that's really sensitive to, PFAS, and it's a lot of the developers and, other M&A activity, other buyers of transactional, properties are really having a difficult time dealing with this issue. And then redevelopment is the other one. The underwriters are always concerned about redevelopment. It's changed over the last couple of years on, on their approach. But let me focus on those two. So PFAS, first, the environmental marketplace is really robust. There's a lot of environmental insurance companies and underwriters who are entering the marketplace and providing terms. But what is changing a bit is when you get into sort of PFAS and redevelopment risk, that field of insurance companies really narrows, and so it's really, really important to how you approach underwriters, and also on how you and who you approach. All of the underwriters aren't all cut from the same cloth. They all have different backgrounds. Some have technical backgrounds, and others may have different, just pure insurance backgrounds. So what we try and do is really identify who the best underwriter would be for a particular risk. So what are they doing with PFAS? It depends. Some of the underwriters, some of the insurance companies are mandating a blanket exclusion. It doesn't matter if it's a greenfield, it doesn't matter if it's an office building, they'll just exclude it in its entirety because it's a corporate mandate that's being implemented upon them to say, we don't want to get involved. We saw something similar with mold, we saw something similar with asbestos in the past, and now it's PFAS. But the good news is, you can obtain coverage, and if if someone tells you that you can't get coverage, it's false. We've placed numerous policies where PFAS was an issue, not just a suspected issue, but where it was actually a known issue. And so, what I want to leave you with is, not all of these sites are going to be the same. So again, I want to reemphasize the approach and who you approach when you're seeking this coverage. The underwriters who don't provide that blanket exclusion are the ones that we want to focus on, and those are the ones who will take that individual site and they'll underwrite it as if it were an individual site and not just blanketly put on a PFAS exclusion. The other thing I wanted to mention is, even if you get a certain exclusion, there are ways that you can negotiate that out. Whether it be, re-emphasizing what the deal structure is. At times there would be, if you're developing a property, you purchase a property that may have PFAS or suspected PFAS, but maybe there's an indemnification being provided by the seller or a different party who's retaining some of that liability. In those cases, you can structure a policy where you wouldn't have any exclusion depending upon the strength of the indemnification, where you wouldn't have any exclusions at all under that policy for PFAS. So something to consider. The second thing to emphasize, and not just with PFAS, but any exclusions that you get, don't always accept the blanket exclusions. You can bifurcate those coverages. So for example, if you have a site with known contamination, known PFAS, the underwriters won't provide coverage for cleanup. But what you could get coverage for still is, protection against any third-party claims. Whether that be, a third party is sick from it, or if, they claim they have property damage, they have diminution in value, they can't use their property anymore. So all of these things, you can really bifurcate the coverage, and maybe you don't get everything, but you can focus on getting, as much as you can, whether it's, property damage coverage or bodily injury coverage. And business interruption, I think, we sometimes we tend to overlook that. If you have, a delay because of discovered contamination, those are types of coverages that you can, obtain. But before I go down too deep, I wanted to ask who in the audience actually used environmental liability insurance, or who is familiar with it. So, fantastic. The second, as I mentioned earlier, the redevelopment is sort of the second topic that the underwriters really are concerned about. And it's not just general redevelopment, but what they're concerned about is you digging down deep. So there's major subsurface disturbance. And that's really a trigger for the underwriters. What we've been seeing is not just an increased number in claims, but the severity of the claims have been really, really, big. So what's happening is the underwriters are putting certain exclusions on the policy, but still providing you with, fairly broad coverage, but they want to protect themselves in the event that, you dig down in this box where the foundation or the footprint of your building is, and you want to put in an underground parking garage, for example. They don't want to be on the hook for them to pay for removing that soil. They consider that a construction risk. So instead of getting an exclusion for redevelopment in its entirety, what we've done is try to narrow that exclusion to the footprint of the building. So anything that you dig within that footprint of the building, what we call is a bathtub approach. And so when you evaluate the coverages and exclusions under these policies, there are various versions of this exclusion. So always make sure that you're getting this bathtub approach, so that this redevelopment exclusion wouldn't apply to the entire site, but just to that footprint of the building. And sometimes you can get that removed, but it kind of depends. But what we're seeing more and more with the redevelopment coverage and the trend is that the underwriters are protecting themselves by utilizing that, again, that bathtub exclusion. Any questions? And I'll just quickly talk about the rate. Again, as I mentioned earlier, it's really a robust market. There are a lot of insurance companies who are underwriting environmental insurance. So what that does is really creates competition. I'd say over the last 10 to 15 years, the rate has remained fairly stable. So I'll just give you this, just and you can, I don't know if we make this available, but if not, then I'm happy to send any of this information or any further detailed information to you. But what the pollution liability policy really does is it provides the opportunity to sort of like cap your costs by providing you with cleanup coverage, protecting you against any third-party claims for toxic tort, which includes bodily injury or property damage, as I mentioned earlier. Any type of like regulatory or legal type of claims against you due to contamination or release on your property. It also provides for civil fines and penalties, which in the past those were excluded, but now the underwriters are providing a bit broader coverage and offering that type of offering you coverage for those types of fines, and legal defense costs and business interruption, as I mentioned earlier. I'll just give you, and cost overrun coverage, I'm not sure if anyone's familiar with it, but basically what it does is it provides you with an opportunity to cap your costs. And so, quick example is, if you have a $5 million cleanup, you can get coverage on top of that $5 million of that known anticipated remedial costs in excess of a deductible or what we call like a buffer layer. So if you have a $5 million project, you get, maybe the deductible is, $500,000, then the insurance would start kicking in at $5.5 million for any cost overruns you have that are unanticipated for cleanup costs.
John,
Yes.
what markets are providing cost overrun coverage at this point?
So I'd say there's probably 3 in its entirety, and they're not very well marketed either. So you kind of have to seek them out, but they will provide, they'll underwrite those on a case-by-case basis. But what we're seeing more is, there's certainly increased scrutiny, as you're probably aware. There's increased engineering, so they're being very selective about what they're providing, what they're insuring. So for example, a dig and haul project, they won't do it. It's not a good risk for them. They don't think, one, they're not holding on to the funds or the money or the premium that you paid. And secondarily, to delineate it horizontally and vertically, and it's kind of hard. So I think what we've seen in the past when, the cost overrun coverage was much more available in the marketplace, the losses that were occurring, a lot of them were due to soil-related projects. So, again,
What markets other than these are offering this?
So Insure is sort of the other one that we're working with, and and my colleague Greg can sort of fill us in more after this presentation if you want to learn more. Yeah. I'll just quickly talk about the property market. I'm not sure who's feeling it personally, but I'm personally feeling the effects of living in California, the increased insurance costs. So what happened was, there's been, over $100 billion in property losses over for the 4th consecutive year. So it's really impacting the rates in the U.S. and globally. But what's happening more specifically in California is, there were 7 out of the top 12 insurance companies exited. And why? Because one, they couldn't get enough rate, so the premiums weren't matching what the losses that they were paying out, and the rates are filed in California, so you can't arbitrarily just say, hey, I want to charge X amount. They have to be approved, and so the approval process, they weren't allowed to basically increase their rates. And so what happened was they actually ended up exiting the marketplace, which then created, sort of less competition for the carriers who were doing it. Thank you. I had a discussion with someone today, and they were a developer, did a project in Oakland, and they had estimated their property insurance and their builder's risk insurance at $1 million, and it ended up being more than double that amount. So I think, and that was based upon their past experience that they, that they had budgeted $1 million, but because of what the market is currently doing, it's, it more than doubled. So just something else to be aware of. And then I'll just quickly mention, the FAIR plan. I'm not sure who's familiar with that, but, it was really established as sort of like a stopgap coverage for property insurance